Welcome to The Explainer. Today, we're going to talk about something that every single business, from a tiny startup to a massive corporation, absolutely relies on. It's the language they all speak to understand their financial health.
All right, here's a fun one for you. What do the founder of Nike and a former director of the FBI have in common? I know, it sounds like the setup to a really weird joke, right? But the answer is a skill, a really powerful skill that was a huge part of their success.
And that skill is accounting. Yep, you heard that right. Both Phil Knight, the guy who started Nike, and Thomas Pickard, who used to direct the FBI, studied accounting in college. So why accounting? Well, they both understood that it's way more than just numbers on a page. It's the key. It's the language that tells you the true financial story of any organization.
Okay, so we're calling it the language of business. But what does that actually mean? Let's get into it. So here's the textbook definition, but let's make it simpler. Think of accounting as the official diagraphy of a business, just told with numbers instead of words. It's a system, a process for identifying, recording, and then communicating everything that happens with money in an organization. And that whole system, that process, really just comes down to three basic activities. Okay, so here they are. First, you have to identify the economic events, anything that affects the company's finances. Then, step 2, you have to record all of that. You classify it, you summarize it, you basically get it all organized. And finally, you have to communicate it. You put it all together in reports called financial statements so that other people can understand what's been going on.
All right, now we get to the core of it all. The absolute bedrock of all accounting. It's a super simple equation, but it is so powerful. And the most important thing about it, it always has to be in balance.
So think about it this way. You can look at any business from two angles. On one side, you've got what the business owns. We call these assets. This is all the stuff, the cash, the equipment, the inventory, anything that has future economic value. Okay, so that's what it owns. The other side of the coin is who has a claim on all that stuff. And there are only two possibilities. First, you've got liabilities. This is what the business owes to other people, like banks or suppliers. And second, you have owner's equity. This is the owner's claim on those assets. That's why it's sometimes called residual equity. It's literally what's left over for the owner once all the debts are paid.
And boom, that leads us right to the big one, the core accounting equation. Assets equals liabilities plus owner's equity. The two sides they must, always be equal. It just makes perfect sense, right? Everything the company owns has to be claimed by somebody, either an outsider or an insider, a creditor or the owner. It's a perfect system of checks and balances. Okay, theory is great, but let's see this thing in action. We're going to follow a little startup called SoftBite and watch what happens with a few transactions. The key thing to watch for is how every single thing they do has a dual effect that keeps that equation perfectly balanced.
Okay, check this out. Look at that first transaction. The owner puts in $15,000 cash. So assets go up, right? But the owner's equity also goes up by the same amount. Balanced. Now the next one is cool. The company buys $7,000 worth of equipment. So the cash asset goes down, but the equipment asset goes up. See that? It's just a swap. The total assets didn't change at all, so the equation is still balanced. And it works for revenues and expenses too. Getting paid increases your assets and equity. Paying rent decreases both. It always works.
So here's the big takeaway. No matter what a business does, buys something, sells something, pays a bill, every single transaction has this dual effect. And because of that, the equation always stays in balance. It's like a built-in fact checker for everything the business does financially.
All right, so after a business has a whole bunch of these transactions, what happens? Well, at the end of a period, like a month or a year, you bundle all that activity up into a few key reports. These are the famous financial statements we talked about earlier.
So there are four big ones: the income statement, owner's equity statement, balance sheet, and the statement of cash flows. What's really cool, and what we're going to focus on, is how the first three are all connected. It's like a domino effect. One statement gives a crucial piece of information to the next.
First up is the income statement. Think of this as the company's report card for, say, the month. It answers one simple question: did we make money? You take all your revenues, subtract all your expenses, and what's left is your net income. People call it the bottom line for a reason. And you can see here, SoftBite did pretty well. They made $2,750.
Okay, now hold on to that net income number, because that number flows directly into our next report, the owner's equity statement. This one tells the story of the owner's investment over that same period. We start with what they had at the beginning, add any new investments, and, here it is, we add that net income we just calculated. Then subtract any money the owner took out. That gives us the ending equity.
And now for the grand finale. That ending owner's equity number we just figured out, it plugs right into our final report, the balance sheet. And the balance sheet is literally just our accounting equation laid out for one specific day. And would you look at that? Assets on one side, liabilities plus that ending owner's equity on the other, and they match perfectly. That's how it all ties together. That's how you know the books are balanced and the story is complete.
So if accounting really is the language of business, the question is, how fluent do you need to be? Understanding these fundamentals is your first step to fluency. It gives you the power to look at any company and actually understand its story, to see its financial pulse. Thanks for joining this explainer.